So the big question is this: how do investors like us who trade options and manage our own money generate income regardless of where the stock market goes, and do it all in a way that lets us make time for the people and things we love, and yet still build wealth and remain profitable? That's the question, and this podcast will give you the answer. I'm your host, Kirk Duplessis, and you're listening to The Daily Call from Option Alpha. Hey everyone, Kirk here again at Option Alpha, and welcome back to The Daily Call. Today, I want to talk about choosing strike prices when buying options. So look, if you're going to go out and you're going to actually decide to buy options, which is not the first thing that we would suggest to do, and hopefully you've recognized that by listening to this podcast and checking out our website at optionalpha.com. But if you are going to decide to go out and do some option buying, you have to understand the relationship that's present between buying options and the price you pay and your probability of success or the amount of money that you might make. Now, understand, of course, that the markets are pretty fair and efficient. So if you trade something that's highly liquid, which we suggest you obviously do in any case, then the market's pretty fair and efficient in that you're not going to get a higher chance of winning by paying less money, is really what it comes down to. So if you think about that as you start choosing different strike prices, you realize that when you pay more money for an option contract, especially when buying options, it basically or effectively means that you're buying options that are further in the money, or maybe closer to at the money strikes. So for example, if a stock is trading at $100, buying the 105 call option might only cost you $50. So it's $5 out, it might cost you $50. But look, the stock has to move from 100 up and above 105 for you to make money. So the likelihood of that happening is pretty low. Hence, the pricing on that option contract is also low to reflect the probability of you making money. Now, if that same stock was trading at 100 again and you wanted to buy the 100 strike call option, that might cost you $2. Now, you paid $2, so you paid more money for that contract, but now your break-even point is 102. So the stock doesn't have to move as far for you to make money on that contract. Now, is it more risky? Well, it's more money out of your pocket, but maybe it has a higher probability of actually generating any return at all. So I always talk about at this point the concept of lottery tickets, because I think the concept makes sense in this case, which people always go out and buy lottery tickets because they're cheap and they have high payoff potential. You could buy a lottery ticket for $1 and make millions of dollars, right? But what's the probability that you actually get any of that money, that you see a dime of that? Insanely low. And the same thing carries, weight with options trading. When you buy, in this case, the 105 call option, yes, it's very, very cheap. It's $50. So it's a small bet. And so on a total dollar basis or a notional dollar basis, it's a very low investment, low risk to you. But it has an insanely low probability of actually paying out. So it acts more like a lottery ticket than anything else. So as we continue down this path of choosing strike prices, again, as you go in the money, now let's say that the same stock's trading at $100. Now, instead of buying the 105 or 100 strike call, you buy the 95 strike call. So you're buying an option that's actually in the money at this point. Now, again, you might pay a pretty decent premium for this. You might pay, let's say, $6 for this contract. So your break-even point is still 101. Stock still has to move higher for you to make money. You're not guaranteed a profit at this point. You still probably need some directional movement in the stock, but your higher payment is also locking in a higher probability of potentially making money. Not that you will, but a higher potential to make money. So you can see that when choosing strike prices, especially in option buying scenarios, you really want to try to understand the dynamic between how far out you buy options or how deep in the money you buy options, and the likelihood of success, right? And so I'm okay taking directional bets, and we do option buying strategies here and there to, hedge the portfolio and reduce risk, balance out other positions. I'm definitely more of the type of trader where I want to buy options around the at the money strikes when I'm doing it. So far out of the money just doesn't make sense. Far deep in the money is just way too costly. And so we find a good risk reward in most cases buying spreads, debit spreads, put debit spreads, call debit spreads, right around at the money. So just to give you guys a quick example of what we might do, if a stock's trading at 100, we might buy, let's say, the 98 call option and sell the 102 call option and do a spread. And most of the time you get a pricing that's right around where the stock is trading. So our break-even point ends up being effectively where the stock is trading now. So we just need a small movement higher, small, trend higher for us to make money on that type of trade. It's still a high, risk trade because it's a 50-50 bet in most cases, which is why we don't prefer options buying than compared to option selling. But if we're going to do it, we're going to do it with at the money strikes or strikes that are around where the stock is currently trading. So as always, hopefully you guys enjoyed these. If you have any comments or questions on this, let me know. Until next time, happy trading. Thanks for joining us on the Daily Call. Be sure to subscribe right now for more daily options trading ideas, strategies, and tactics to help you learn how to place smarter, more profitable trades. And if you like what we're doing, don't forget to give us a rating and a review so we can continue to bring you the best daily content possible. We'll see you again tomorrow, right here on the Daily Call from OptionAlpha.com.